One important thing to understand is your risk appetite. We are going to quantify this as the volatility in your equity curve. Having a high risk profile means that you are able to tolerate high volatility in your equity curve, while having a low risk profile generally means that you are uncomfortable with large swings in your equity curve. Risk appetite determines the type of strategies you're comfortable with and the position sizing level that you're comfortable with. With a high risk profile, you are unfazed during long periods of deep drawdowns. This also means that you are willing to risk more per trade. With a low risk profile, you're comfortable with strategies with consistent equity curve. Even though having consistent equity curve, consistently upward sloping, this is rather difficult to achieve. Your goal in this trading journey is important. Whether you're looking for a full-time income source, a part-time job, or just a hobby, it will slightly affect what kind of strategies you're looking at and how much investment you're going to put into trading infrastructure. For example, if you need monthly income, then you can't have irregular big wins with low hit rates. You need to have a strategy that gives you monthly returns consistently. And if you already have a full-time job and this is just a hobby for you, you probably will not invest huge amount into infrastructure, which is software and data, etc. And one more reason why a goal is important is because it is the source of motivation. This trading robot journey is not an easy one. Having a good motivation to do it will greatly increase your chances of success. We're going to talk about expected equity curve now. Just a quick revision. An equity curve represents the account balance in your account charted against time. So imagine that you have a chart and the x-axis is time, the y-axis is your account balance. It is good to have a broad understanding of the types of equity curve that our robots could have. This is for three reasons. You can better monitor robots and detect anomalies during live trading. You can better understand if the strategy is suitable to your risk profile. And it is also a good starting point for idea generation. So let's start with the first point. We can better monitor our robots because we know how they are expected to behave. For example, if we have a pair trading intraday strategy and we have low hit rates and high returns, there could be a problem somewhere because a pair trading strategy should give us consistent returns and an above average hit rate. This will prompt us to examine our robot and look at the current market conditions to identify any potential problems or anomalies. If we know what type of strategies, what type of robots is going to give us what kind of equity curve, we can choose one that fits our risk profile. Let's say that we have low risk profile. We wouldn't choose a long-term trend following strategy because that entails long and deep periods of drawdowns. One good thing about knowing the expected equity curve of different types of robots is that it's a good starting point for idea generation. Let's assume that we don't have any ideas in mind and we need a starting point. With a preferred equity curve, we can screen and filter away certain types of strategies, and this will hasten our idea generation process by quite a bit. There are three main types of equity curves. Note that we are only going to talk about curve with positive expected payout because it makes no sense for us to run a robot that is expected to lose. The first type is large irregular curves. Second is chaotic curves. And lastly, consistent curves. There are other kind of curves that belong to martingale betting strategies or anti-martingale betting strategies. We will talk more about that later in the future. If you want to learn more now, you can wiki martingale betting systems. This is how a large irregular equity curve looks like. By large, I mean that the wins are large in size compared to the losses. You can see that this win is due to one trade, and these losses are due to many trades. This shows that we have a low winning percentage, but when we do win, we win a lot more than we lose. This type of equity curve is characterized by low hit rate, but high take profit to stop loss ratio. Trend following is one type of robot that follows this type of equity curve. The basis of trend following entails capturing a big trend. Most of the attempts will be misses, but when we do catch it, we ride the trend all the way. This is the shape of a chaotic equity curve. Most strategies fall in this criteria. When we are faced with chaotic equity curve, we should look for patterns. Most of the time, the shape of this curve is not completely random. We should find periods of drawdowns and profits and look at the market conditions surrounding those periods. If we are live trading, then we go back to our backtest and find similar patterns in the equity curve. Then we look at the market conditions in those periods and compare to what we are going through now. This is what a consistent equity curve looks like. Consistent equity curves are ideal. This is usually, but not always, characterized by an above average winning rate, and the losing trades rarely cluster together. This means that when we have losing trades, they are usually not consecutive. When we have a consistent equity curve, it tells us that we are capturing an inefficiency in the market that is persistent. This inefficiency is not significantly affected by macroeconomic factors. Macro factors like change in central bank policies, interest rate expectations, and economic data release, etc. Hence, the equity curve behaves in a similar manner across time. This goes back to our aim, which is to build robots that are market prudent. If the robot is market prudent, there is a rationale for the trade, and this rationale is to exploit this particular persistent inefficiency. Types of strategies include hedge or market neutral strategies, like pair trading, correlation trading, and strong proxy indicators trading. What we mean by that is that when we trade asset A, we look at asset B, C, and D closely and use those as indicators for our trade. So why do we say that our secret ingredient is consistency? 3 reasons. We can leverage with ease, it is easy to track performance, and it is good for trading psychology. With consistency, we can leverage with ease. We can increase our position size without worrying about our risk to ruin. This means that instead of risking 2% per trade, maybe we can do 3% or 4%. The risk of our equity dropping significantly due to high percentage of losing trades and clustering are low. On the other hand, our upside will be exponential due to compounding effect. It will be easy to track performance. Compare 2 strategies, A and B. A has a large irregular equity curve with an average drawdown of say 10% and a period over 2 months. B has a consistent curve with an average drawdown of 2% with a period of 1 week. For A, we won't know if our robot has stopped working until more than 2 months later and more than 10% loss later. For B, within 1 week and 2% loss, we can tell if something is wrong. And when we can identify problems with a robot early, it's easier for us to fix and maintain it. Consistent robots are good for trading psychology. Low drawdown depth and short drawdown periods are great for the trader. Going back to the previous example, where robot A has a drawdown of 2 months, traders with poor psychology will find it difficult to trust the trading robot. Say, after 1 month of drawdown, they will have doubts. They will second guess the strategy and act irrationally. They do things such as pausing the strategy or changing the parameters. They may overanalyze when there is no empirical evidence to suggest that there may be a problem. And by pausing the robot, they may miss the potential big winner that will have made their year. Here's a chart of a chaotic equity curve after we size up. Let's assume that the green line represents a position sizing of 2% and the red line represents a sizing of 4%. We can see the devastating part of sizing up is that our loss is compounded more than our returns. Look at the last part of this chart. Even though there's a streak of winners at the back, it will not bring our equity curve back up above the green line. Remember in our coin flip game, for every 50% you lose, we need to gain 100% to break even. So if we increase our position sizing and cause our equity curve to drop very significantly, even though we have winning trades at the back, the returns that they bring in dollar amount will not be significant. This is a consistent curve after sizing up. Look at that, looks great.